everyone, and welcome to our virtual AJ Bell Connect session. Appreciate the run up to Christmas can be especially busy time, so thank you for sharing your time and joining us today. We did debate whether to run this session internally with a bit of networking afterwards, which is always one of my favourite sessions of the year, or just to go ahead with a virtual session. Feedback was around 50-50 in terms of online or offline, just with the emergence of the new Omicron variant, which I'm sure you're all sick of hearing about right now. We just felt like it was the wrong time to do a session at the office. So hopefully this will be the last virtual session we'll run for Connect. Next time we'll see you in the office for a drink and some nibbles afterwards. No impact in the quality of the event. We've got 2 hours of CPD with some fantastic speakers to follow me. As always, any questions through the course of the event, please feel free to use the chat functionality or email me or Kirsty after the event, and we'll make sure you get the answers that you need. You'll also have a questionnaire that's going to pop up around the end of the session. It's going to take you a maximum of 2 minutes to complete. On receipt of that, you'll get your CPD certificate, and also be great feedback from us in terms of the event and how it's fallen from your end. And of course, any improvements, please feel free to share with us. You'll notice that I'm sporting a particularly terrible Christmas t-shirt today, and what we're looking to do is encourage you to share pictures of your Christmas scenes at your end. So whether it's your Christmas trees, your dogs or cats in Christmas jumpers, your own festive attire, please share them on LinkedIn or Twitter with the hashtag AJBellConnect. Please feel free to tag in @InvestCentre as well. At the end of the session, we're going to judge the best pictures we get in, and the winners will get a bottle of champagne each. So there'll be 3 winners. Bottle of champagne will be winging its way to each of those after the session. So without further ado, just a quick intro there. I'm going to switch straight into my session, which is just a quick update in terms of everything that's happening at InvestCentre, with a quick review of back office functionality. So here we go. Okay, so what's new at InvestCentre? We've just published our annual results to 30th of September. First chat we're going to look at is the improvement in the platform figures for the last 6 years. We're taking the opportunity to do a bit of a retrospective look back in terms of InvestCentre numbers from 2015 to 2021. As you can see here, we've increased our share of the market by market growth by 100%, and our share of the market as well by the best part of 2.5% as well, which is great to see the increase in those numbers. Just focusing in on InvestCentre, you can see that we've grown our customer numbers over the course of the year by 17% to 127,000, thereabouts. Average customer profile is 57 years old. Last year they were 56. Average assets are 361,000, up a smidge from last year, and we've also improved the number of accounts per customer held, which really I think is great evidence that we're moving from being just a SIP provider to really being viewed as a platform provider as well. We're seeing customers start to use our complementary products. All this is organic growth as well, so fantastic support from advisors such as yourself. So many thanks from me. Next slide is just a quick overview of the proposition. In 2022, we're going to be launching 2 digital platforms, Touch and Doddle. You may have seen some press last week on Doddle, which is on the UInvest side. We're not going to be forgetting our advisors, so next year we'll be launching AJ Bell Touch, which will be a completely digital proposition on the advice side. This will be a web experience for yourselves, but for clients it will be a completely digital experience, so they'll be using their smartphones to access the platform, and you'll also have the ability to instruct rebalances, change of advisor charge, etc. Through your interface, which the client can authorise via the app. More of that to come, and we'll be happy to demonstrate Touch in the new year. Straddling both the advised and D2C platforms is our range of investments. D2C gets access to our range of multi-asset funds, whereas the advised platforms will benefit from access to our range of model portfolios, plus our partnership proposition as well. So if there's any firms out there that are looking to bespoke their investment proposition, then please feel free to get in touch with us and we'll talk you through our partnership offering. Next up, we're going to focus today on back office systems, just to have a quick look at those. So no doubt you'll all be familiar with back office systems at your end, so Intelligent Office, Advisor Office, and you'll be aware that the efficiencies these can bring to your businesses. We're also heavily reliant on back office technology to streamline our business. which is one of the reasons we can offer such competitive pricing. You might not really have considered how many moving parts there are, so we're just going to highlight above the number of efficiencies these bring to our business, and also the benefit that the back office can bring to us. Many of these are interlinked, so failure in one area can really have a kind of a follow-on effect on different areas as well. In terms of scale of use, just to give you a bit of a context, so wrap some context around the processes. These are some numbers that are given to me by our client services team. So we've added 86,000 new customers. All of those need to go through the back office. 2,000 plus transfers in a month. Again, they're all processed by the back office system. 25,000 PCLS or UFPLS payments a year. 15,000 one-off income payments. 1,100 advisor charge amendments per month, plus a range of other processes that our back office system needs to process each month and each year, just to ensure the smooth running of the Invest Centre platform. Just to focus in on the marketplace a little bit at the minute. So what you'll see here is a chart that's documenting the use of various back office systems. What you'll see is a reduction of people using proprietary technology, and really the ascendancy of the big two, which we'll look at, is FNZ and GBST. This is taken from the Lancat State of the Platform Nation from last year, and really kind of you'll be able to see there that actually we've got people relying on their own technology and starting to outsource that to larger providers, and you'll have seen some people move from provider to provider or from proprietary tech to outsource tech as well. What they've done is they've projected the figures forward as well. So you'll no doubt be aware that Nucleus was acquired by James Hay, and they will be transitioning the technology from Bravura to FNZ. So that orange line you'll see there is an uptick going forwards with the inevitable transfer of the Nucleus book onto to FNZ. And again, you'll see a similar downtick in the Bravura technology where the assets start to move off the platform. But interesting there just to see a real rise of the big two, to the point where FNZ did agree a deal to acquire GBST. Both of these businesses based in Australia, so interesting that the CMA, the Competition and Markets Authority over here, decided to step in and actually block this merger. Martin Coleman, chair, said, based on the latest evidence, we have come to the provisional conclusion a merger of FNZ and GBST would significantly decrease competition in the retail investment platform solutions market, and really that will be to the detriment of the consumer. So they just felt that the two big back office providers merging to form one would really leave kind of very little place for competition in that side of things, and the net loser in this would be the end consumer. So moving on to replatforming, the best analogy that I can refer to on this is our good friend Abraham Okusunya from the independent consultancy Finalytic. Abraham's analogy is you imagine you're driving your car down the motorway at 70 miles an hour and no more, and you need to change the engine. The thing that drives your car with no drop off in performance or forward momentum. Replatforming is similar. You need to continue to move your business forward, process client income payments and advisor payments, but actually change the very thing that drives the business ahead. I'm sure you can appreciate that's a fairly challenging task. So replatforming from this to this. So obviously you've all no doubt had experience where the car simply grinds to a halt and you're faced with some serious tailbacks. Our personal experience of this is that the success or lack of comes down to bulk processes. Day 1 to the first week might look absolutely fine. When these new platforms start to run some of their bulk processes, so income payments, advisor charge reconciliation, bulk dealing, etc., this is when it really tests that new technology. And if one of those falls over, then it's a bit of a domino effect and can cause some kind of fairly serious repercussions and kind of a real struggle to catch up in terms of providing a seamless service to you and your clients. So leading on to changes in the industry, we've seen some fairly significant merger and acquisition over the last year, 18 months. To highlight a few, we've had a double acquisition by private equity firm Anacap that bought Novia and Wealthtime. Premium also looking to exit the UK market, so they're in the final stages of selling their UK platform. Embark, again, have been purchased by Lloyds Banking Group. We've also seen James Hay and Nucleus. James Hay acquired Nucleus, which again was part of that FNZ technology. Parmenion fairly recently been sold to a private equity house, and you'll have no doubt been aware that Parmenion have had to put their fees up probably to generate the return that PE firm is looking. And again, even more recently, we've seen Interactive Investor has been acquired by the Aberdeen Group, and Interactive Investors on FNZ technology, which will kind of further strengthen the Aberdeen reliance on an FNZ to power their platform. But again, they're moving into the D2C space as well. Just looking back in terms of ownership structure, what we had in 2016 was kind of predominantly life co and privately owned. Moving forward to last year, that's moved really. You've seen privately owned has reduced significantly, as has life co. What we're now seeing is publicly traded platforms, so a number of platforms have floated, and asset management, and the emergence of private equity. I think if we did fast forward this as well, we'd see that PE slice of the cake increase a little bit with kind of the acquisitions that we've just seen on the previous slide. But as you can see, the landscape over the last 5 years has changed significantly in terms of who owns these platforms. I suppose the question you need to ask is, ownership structure really will drive what they want to get out of the platform. PE will potentially want different things from privately owned and live co-owned platforms, and we've seen a shift towards that over the last six or so years. Okay, just to touch back on the first slide, so the new proposition that we launched is Touch by AJ Bell. This will be going live over the course of the next year. It's a business that we acquired previously called Adalpha, so you may have seen some press on that side of things. We acquired the business that's now been rebranded to the Touch. The whole proposition's been changed to AJ Bell colour schemes, but really this is going to be offering your clients a kind of a digital experience. So for those clients who are glued to their smartphones, might be a fantastic solution to them, where they can access their platform investments and validate everything they need to via their smartphone rather than having to log on to websites. In terms of look and feel, this is the advisor website that sits behind, and this is the client app that sits in front. As you can see, the client has access to view their holdings on there as well, but also gives them a bit more functionality than a standard platform app. So it's not just a visibility thing; it also gives them the ability to change address, bank details, etc., which will just drop straight into the underlying platform without any requirement for input from yourselves. And again, you can validate trades, etc., through the app. So really exciting piece of technology, and look forward to running you all through it in the new year. And final piece for me is a bit of functionality that we launched a couple of months back, which is multiple funds and shares on ISA. I think with the emergence of more managed solutions on our platform, so we're now delivering NPS solutions from even more DFMs than we were at the start of the year. One of the restrictions on ISA was that you could only have one funds and shares account, and for advisors looking to blend different providers, blend different solutions from providers, this was a real drawback. So what we have done is we've launched the ability to do multiple funds and shares accounts in a single ISA. This was built from the ground up on our new version 2 site, so it's a completely online process. You can set up new accounts up to 4, and you can also move assets between the main funds and shares account and any of these subsidiary pots by a single instruction. Again, that will take 24 hours to move the assets across, and any cash that you want to move will take around 15 minutes. Again, we'll look to extend that to the wrappers, but any questions on any of these things, then please feel free to let me know, or anyone in the support team. But yeah, finally, thank you for your time again, and we'll move on to the remainder of the sessions. Up next is speaker James Bird, Business Development Manager from Fidelity International, who are returning event partner for AJ Bell Connect 2021. So many thanks to them. Today, James will be looking at the income dilemma and ways to find an investment solution to sustain retirement. He'll address some of the key issues shaping the landscape across traditional and alternative areas of income, and look at how income seekers could best allocate their assets to navigate the tricky environment. Is his Christmas jumper as good as mine? I doubt it. Let's see, shall we? Over to you, James.
Well, hello everybody. Great to see you all so close to Christmas. My name is James Bird from Fidelity International, and this presentation is all about the income dilemma, finding an investment solution to sustain retirement. Now, before we get into the presentation today, there is a functionality, a box to ask questions. As you go through, please feel free to put questions, feedback, comments into that box, and we will get back to you on those during or after the presentation. The reason I use this title today around the hardest problem in finance, as it's called, is I think this is probably the question I've been asked most by IFAs across this year, which is how do I generate and create a solution that pays an income for clients in retirement with everything else that's going on in the world with regards to markets, inflation, interest rates, and the like. So in terms of the next half an hour, as always, I've broken down the presentation into 3 parts. So I'm going to start by explaining why is it just so challenging and just so hard to find that income in retirement. That's all about the macro environment. We'll then leave the macro behind and take a forward-looking view and think about why asset allocation differs between 2 approaches, between natural income and accumulation. And then I'll bring it all together at the end and talk about what kind of investment solution do I think could fit in and help you and your clients through this journey. So that's our roadmap, if we can call it that, for the next half an hour. So look, let's get straight into it. And I'm going to start by asking you a question. I want you to look at the 4 photos that you can see on the screen and either just jot it down in front of you or feel free to write it in the chat box. What year do you think these photos are from? So they're all from the same year. What year do you think they're from? I'll give you sort of 10 seconds to have a think. There's a couple that gives it away. So you might have got it. I'm seeing some answers are coming through. It was actually, of course, 2016. Top left-hand corner, Boris Johnson when he was campaigning for Brexit with his head in his hands. He doesn't look particularly happy. Bottom left, you might see here, or remember, Usain Bolt when he won the 100 meters, the fastest man in the world that was so quick he could turn over and look at the person next to him when he was going over the finish line. Bottom right-hand corner, England, rubbish at football, losing to the mighty Iceland. And the best picture, I think, is in the top right-hand corner here. So this is a Donald Trump supporter coming face-to-face with Donald Trump for the first time. And I don't know if she's shocked, excited, amazed. You can make your own minds up about that one. And interestingly, 2016 was the last time that we were out on the road speaking to advisors about this income dilemma, about this problem. Now, fast forward 5 years, and those themes are still here, but of course they've evolved. So England are marginally better at football, just marginally. And in the bottom left-hand corner, of course, Brexit has now happened, and we're working through what that means for the economy. In the top right-hand corner, think back to January of this year, the raiding of the US Capitol. I still can't quite believe that happened. When you actually think back to January, that this bastion of democracy was taken over by protesters, but there we go. And in the bottom right-hand corner, Boris Johnson with an ice cream, looking slightly happier, although based on the evidence around Christmas parties in Downing Street, around the funding of his or refurbishment of his flat, I suspect that he's probably a little bit less happy. And I think that's one story that won't go away as we move through Christmas. So again, the theme for this presentation will be that lots of those themes are still here, but they've evolved. Now, let me give you the background around this theme of income. And I think this is probably the most important chart I'm going to show you today. So what I've done here is I've charted different approaches or different assets, starting on the left-hand side with safe assets, that's cash, government bonds, corporate bonds, emerging market debt. And as you cast your eyes to the right-hand side, we move up the risk scale. So you're seeing different levels of risk. Now, you've got 2 comparable notes on the chart. If you start by looking at the kind of dotted line or the shaded line, those were your yield levels in 2007. Now, it goes without saying that 2007 was a very different time for investors and actually for the world at large. So in 2007, the first iPhone was launched. In 2007, Milan got their revenge on Liverpool in the Champions League final. And believe it or not, in 2007, Vladimir Putin was named Time Magazine's Person of the Year. So it was a very different time. Now, for us as investors, of course, it was incredibly different because those safe assets on the left-hand side were paying a yield or an income level of 5 to 7%. Now, when you look at the yield levels for today, many of those safe assets are actually now paying next to nothing, or in some instances a negative yield. Now, as a reminder of how a negative yield works, let's say I loaned you £100 to go and enjoy some drinks at Christmas. You're thinking that's probably not a bad not a bad outcome for a webinar. But if I loaned you £100, I would loan you the £100 and I would pay you to loan you the money. So it kind of turns economic logic on its head. And with those sort of levels of negative yielding debt in the world, what it's doing is it's forcing investors up the risk scale, up to this part of the chart, to find the same level of income. And for your clients that perhaps are in retirement, it does make it incredibly difficult. So if that's the backdrop, we then have to ask, well, why are we in this environment? And the first reason, of course, is the amount of debt in the world. Apologies for the quite colourful chart, sort of first thing, but you can see here that there are 3 countries now with a debt to GDP ratio of over 200%. And as you cast your eyes out to the next sort of ring or circle, there are now over 30 countries with a debt to GDP ratio of over 100%. 2 I'll highlight. You can see at the bottom the UK with 107%. That's the first time the UK's debt to GDP ratio has been over 100% since 1961. And just north of there, you can see the US, 133%. Just to put into context how indebted the USA is, during the last 18 months of COVID, the USA have printed more money than they spent on the whole 20-year war in Afghanistan. So printed more money than they spent on the whole 20-year war in Afghanistan. Now, you might be thinking to yourself, okay, James, I get it. The world's indebted, but why is this important for low levels of income? Well, with a world that's swimming in debt, you need low interest rates to help sustain this amount of debt. Because if interest rates go up, not just countries and governments, but also businesses and people in their own lives can't actually pay that debt back. Now, again, this is put into context here. What we've got are historically low interest rates. This chart going all the way back to 2004. And if you look on the right-hand side of the screen, you can see quite clearly that actually interest rates are at their lowest level for a number of years. Now, the analogy that I like to use, if any of you have been to a Christmas party, and I'm sure there's a few of you that have been to Christmas drinks or a Christmas party, if you go to someone's house, maybe to get the party going, they might have a big kind of bowl of something quite alcoholic. So, I don't know, a bowl of punch or a Christmas sort of drink with a few spirits in, and you have a few kind of drinks of that, and you think, I'm actually enjoying this Christmas party. I was feeling a bit apprehensive, but I'm actually now enjoying it. Now, when you're there drinking the punch or you're having a good time, of course, it all feels pretty good. But at some point, you need to get an Uber home, and at some point, you need to wake up to the hangover. And this is really how the world economy is functioning at the moment. We're drunk on low interest rates, we're drunk on debt. But again, as rates do start to move up, we will find that the economy, I think, does struggle with higher interest rates. In terms of what your clients might be asking about rates in the UK, I think as a sort of, I don't know, not a finger in the air, but I think February is likely for the first rate in the UK up to 0.25%. And we don't see any kind of big derailing of the economy from the Omicron variant. I'd expect interest rates in the UK to be around 1% by the end of next year. So that's the figure in my head. So moving up, but again, at a historical level, still fairly low. Now, alongside sort of debt and interest rates, we've got really a situation around a world economy where people are getting older than ever before, and in fact are actually the world population is growing. And I don't know what's happened to my chart on there, but what I was showing you is the fact that the world population, when it comes to demographics, is in fact getting older and getting larger than before. Now, what I mean by this, if you think about your world population, if the proportion of the population that is over the age of 55 is increasing as a total of the total population, what this means on a longer term view is actually, if you think about your own client bank, think about people that move into retirement, typically those clients are going to be buying bonds. As they buy bonds, what does that do? It pushes the price of bonds up. On the other side of things, if the price of the bond goes up, the yield level of the income comes down. So the formatting on my chart, and it's not working this morning, but again, the key message there is with an aging population globally, we think this will result in lower levels of income. Now, alongside this, of course, we've got a question around inflation, and this has been the big topic on everyone's lips this year. And really, I think, if the word of 2019 was unprecedented, I think the word of this year has all been transitory. So people have asked, is inflation transitory, or is it here to stay? I'm very much in the camp that inflation is going to be here to stay. On the left-hand side, we know that deglobalization is having an impact on inflation. If you think about the supply chain crisis that we've seen, think about something like a cargo ship that's going from China over to the USA. In the first half of this year, that took approximately 40 days. With COVID outbreaks, that now takes 84 days on average for that ship to get from China to get to the USA. And when you've got economies globally that are more inward looking, this will lead to increased price pressures throughout next year. Alongside this, of course, we've also had a huge amount of spending from governments, a return to expansionary fiscal policy. I always go back to that quote from Larry Summers, who worked under both Obama and under Clinton. And he said that the spending we've seen by governments during COVID will lead to inflationary pressures of the kind that we haven't seen in a generation. So inflationary pressures of the kind we haven't seen in a generation. Now, with all that in mind, of course, one thing I would keep an eye on for next year is this idea around stagflation. This is where inflation rises, but growth falls. And that's a real headache for policymakers because it puts them in a tight spot when it comes to thinking about interest rates and policy tools. What I would say is, if you do want a bit more information on this, we've recorded something called the Inflation Podcast. Now, I know you're probably sat there thinking, come on, James, I've got better things to be doing. But if you've had enough Christmas TV, if you've had enough of the in-laws over Christmas, it's a really interesting podcast. It's about half an hour that looks at lots of this stuff around inflation and can give some quite nice talking points for clients. So again, if you'd like that inflation podcast emailed over to you, please feel free to put it in the chat box or feel free to put it in the feedback afterwards. So look, inflation is one thing. And of course, the other thing to keep an eye on is all around the themes of climate change. This is a picture from the wildfires in Greece back in the summer. We know that in the time of the ancient Greeks actually used to light signal fires to show that the enemy was coming, whether that was the Romans or the Persians or whoever it might be. But of course, the enemy in the sense of climate change is here now. Now, when I think about climate change, I don't think about it in the sense of, okay, this is protesters that are blocking the M25 and everyone has their own views on climate change. What is undoubted, though, is this will have an impact on portfolios. Think about this kind of move to net zero. What will be the impact on asset class returns? What will be the impact on inflation? What will be the impact on how a portfolio looks over the next 2 to 3 years? And when you think about the income dilemma that we're in, again, this is just an extra layer of complexity to what is already, I would argue, quite a challenging environment. So again, with that in mind, what I would say, and if you didn't think or if you thought the inflation podcast sounded bad, we've got something else called the carbon report. Now, it's a 2-pager. It looks at some of the impact that this stuff has on strategic asset allocation and on portfolios. And again, if you'd like that emailed across to you, please put in the chat box carbon report and we'll get it sent over. I promise you it's better than it sounds as we come up to the run into Christmas. So look, with all that in mind, with the fact that we're in a low income world, we've got debt, demographics, we've got low interest rates, inflation to worry about. We've then got to worry about climate change. I'm going to ask you a question. So what is the biggest issue for your clients? Is it persistently low interest rates? Is it the threat of inflation? Or is it a preference to invest sustainably? So I'm going to give you 10 seconds just to have a think about that. Feel free to put it in the chat box or feel free just to have a think about it yourself. It seems like there's a few answers for inflation. I know that ESG is up there for a number of people, but what I will try and do is in the second half of the presentation, try and get through and answer these questions for your clients. So let's think about tuning up your income ideas. And I think the best way to do this is to start with a survey from the advisor community. So this is from Platform, and it looks at the most popular solutions in drawdown. And it's quite clear to see at the top of the slide here that the most popular methods of solutions in drawdown are taking regular income and capital withdrawals, and then also just beneath it, taking a natural income. So those are the two that I'm going to focus on for the purpose of the rest of this presentation. So as a quick reminder in terms of how these two approaches look, on the left-hand side, if you're using a natural income approach, we know that your initial investment is left untouched. You do get some mitigation against inflation, but it's worth remembering that if you're looking at a natural income approach, income volatility makes budgeting a bit more difficult. So you don't get that consistent level of income with a natural income approach. On the right-hand side, if you're using a compounding approach or decumulation, you get the benefits and the flexibility to take cash. But again, one of the drawbacks at the bottom here is you have pound cost ravaging. So again, that talks about sequential risk. So when do you enter the market? And when you do enter the market, can have a real impact in terms of the returns for your clients. So that's a reminder of how the two approaches look at a very kind of a sort of top level. And if I kind of drill down a little bit deeper, what I've done here is I've tried to show at a very kind of broad look how the two portfolios might look. So on the left-hand side, you can see that a natural income portfolio has a slightly higher allocation to equities. That's because, again, we're looking for a slightly higher level of yield. On the right-hand side, you can see that we have a slightly higher allocation to cash, again, because we need it for capital withdrawals. Now, again, if you look at these two portfolios side by side, I would argue that it's quite a tricky environment for investors at the moment, because on the one hand, we know that equities have been in the fastest bull market in history this year. Until about 2 to 3 weeks ago, I think it was 200 days since we'd seen a correction of 5% or more. But on the other side of things, the bond market is flashing warning signs. Yields have been falling pretty much for the bulk of the year. So as an income investor, you go, what on earth do I do? Where do I allocate? And what I'm going to do for the next sort of 10 minutes is give you some best ideas. And this is whether you're using a model portfolio, whether you're using a multi-asset fund, or you're picking your own funds. I'm going to try and give you some best ideas for next year. So we're going to start by getting into defensive assets. And let's start with the most defensive asset of them all, which of course is thinking about cash. Now, what I've done here is I've plotted the UK base rate, which is the black line that you can see, and the kind of squiggly lines that you can see coming up off the screen. Those are the anticipated cash rates from the market. Now, what this shows over time is even though the market anticipates cash rates to move up in the UK, you can see on the bottom right-hand corner that they've stayed stubbornly low over the last 10 to 12 years. Now, I think the current cash rate in the UK is 0.64%. So as an income investor, we know we need some of it for a capital buffer, but it doesn't offer the level of income that it perhaps used to. So we've got to look a bit further afield than cash. So that then moves us to the bond market. And I'm always brought back to the quote by Bill Gross, who was the bond manager or the bond guru that created PIMCO. And he famously said that cash is trash. And he came out about 2 to 3 months ago and said cash is trash. But I also now think that bonds are trash as well, or government bonds are trash as well. So as a bond investor, you go, where on earth do I allocate for the coming year if everything's trash? Well, 3 sort of ideas that I'd sort of keep an eye on. And again, this is if you're picking funds, or this is what you could expect to see in a multi-asset fund. And the first thing is I'd expect to see an allocation to emerging market debt. We know that emerging markets have had quite a tough year on the back of worries around the vaccine rollout, around global growth. But again, thinking forward, remember that emerging market debt selectively offers a better level of yield. It offers diversification. And as part of a balanced portfolio, we think could be offered again, but you've got to be selective with emerging markets. The second theme is around the economic recovery. We've seen, of course, again, the Omicron variant has actually started to derail that economic recovery. So I'd imagine a strategic bond manager would be hunting around in those areas. So things like hospitality, conference centres, to find some opportunities. Just on the word of Omicron, my personal view is I think we will see data that comes out in early January that says that it's not as deadly as people think. And that will be the signal for the next leg up of the bull market. But let's wait and see. I'm definitely not a scientist, but if I was going to sort of think about that, that would be one theme in case your clients are asking. Look, and on the right-hand side, we know that fiscal policy will be a huge driver of growth. Now, Joe Biden has promised $1 trillion. I think he's trying to get through another 4 trillion. So he hasn't seen my slide on debt. But again, what I would say here is when you're thinking about what does this mean for the bond markets, think about things like infrastructure businesses that of course will benefit from this spending. And again, if you're not looking into the nitty gritty, your strategic bond manager should be looking at that for you. So there are going to be opportunities to find an income next year. Now, one question I've been asked by advisors on this subject is, should I be looking at ESG for bonds or sustainable bonds? And what I would say is there are three main challenges around investing for a sustainable bondholder. So firstly, if you're looking for a low carbon approach, you can't go passive, I don't think. You need to be looking at active approaches to get the full picture. There is lots of talk in the market about green bonds. So these are bonds that are used to finance sustainable projects. But again, they're small, they can be less liquid, and they can deliver less yield than the global corporate bond universe. So if you're looking at green bonds, you've got to be selective, or your manager's got to be selective. And again, at the bottom, when people talk about divesting or excluding, or we're going to get rid of all our fossil fuels, someone else is just going to go and invest in those businesses. So it's all about engaging, active engagement with businesses, as opposed to just excluding. So there are some challenges when it comes to investing sustainably for bonds. Now, on the other side of things, being a sustainable issuer can actually pay off. Now, what I've done here is I've used the Fidelity as sustainable ratings for bonds. A is the best and E is the worst. And this shows during Q1 to Q3 2020 that those bonds with a better sustainable rating delivered better returns for clients. So again, it's quite early data and it's kind of, the very kind of beginning of this journey. But on the other side of things, despite the challenges, we do think that sustainable investing for bonds can pay off and might pay off over time. Now, to give an example of how this might look, VW, of course, probably one of the most famous businesses when it comes to climate change and bad governance. I can't believe that Dieselgate was 10 years ago, but actually since then, VW have made some huge improvements in terms of the spending they're committing to electric cars and to improving their carbon footprint. What's interesting though is MSCI still give VW the worst rating of CCC. We've actually given them a rating of B because we think that they're improving in terms of the way that they run that business through a sustainable lens. So again, my message here would be, if you're looking at ESG or sustainability, sometimes the backward-looking ratings don't quite do things justice. It's about looking forward and thinking a bit differently. Now, on the subject of looking forward, this is a bit of fun, but there was a UN report that was published that said that actually 40% of global warming since the Industrial Revolution has come from cows and has come from methane. So the majority of that, of course, comes from cows. Now, as a world, of course, we're trying to think about how we can get to this target of 1.5 degrees Celsius by 2040. And in terms of the output from this UN report, it actually suggested that if we could cut methane emissions by 30%, we could cut out or remove 200,000 asthma-related deaths every single year, and again 750,000 related illnesses every single year if we could get methane emissions down. Now, there are some businesses that are taking a very forward-looking view and are thinking about how to do this. There's a Danish business called Mutral. They're actually developed a lemongrass cow feed that they think can reduce cow emissions by 38%. Again, I've said before, I'm not a scientist, I don't know how that works, but that made me chuckle. And there's another business that have actually created a cow face mask that when the cow kind of belches, it belches and it turns it into harmless oxygen. I had a client, quite an astute client, I was delivering a similar session up near Manchester about 2 weeks ago, and they said, James, how does the cow eat, drink and just enjoy its life with a face mask on? And I sadly don't have the answer, but on a forward-looking view, I'd expect to see a few more of these ideas and a few more of these forward-looking ideas over the coming years. So look, into my final kind of 5 to 6 minutes, and I'm going to look at the other side of things and think about the growth side of your income portfolio, so equity, and of course we've got to think about property as well. And the first thing to say here is regulation is everywhere when it comes to thinking about equities and especially to dividends. Dividends have had a really tough year over the last 18 months. Of course, they've been cut, often a sign of prudence, I think, from businesses. But interestingly, the pensions regulator has now said that if dividends or if pension businesses aren't matching their liabilities, they'll step in and stop dividends being paid. So the regulator is coming down even harder on businesses that aren't keeping up with their pension liabilities. Now, what this means in terms of kind of the broader outlook is, on the right-hand side, businesses in the USA as an income investor for dividends perhaps look a bit more interesting. On the left-hand side, the UK, of course, has been a bit more beaten up. Now, what I would say going forward into next year is I wouldn't dismiss the UK. Sort of two or three things here. So firstly, the cuts that we've seen in dividends in the UK are often a sign of prudence, a sign of capital management from businesses. And if we have lockdowns or restrictions, as we saw announced this week, those businesses with cash on the balance sheet should benefit. So that would be the first thing to say. The second thing to say is, when you think about UK businesses as a whole and the UK market is still incredibly undervalued. We're still trading at a 40% discount to the USA. So for long-term investors, we know there is an opportunity in the UK. And the third thing I'd say is, even from an index approach, the FTSE's historical yield, I think, is north of 4%. So, and we do have lots of businesses that will pay a sustainable income for clients. So again, you might have been put off the UK after the last couple of years, but it might be worth looking at a UK income fund for the next year and beyond. Now, alongside this, a very quick word on sustainability. Again, these are the Fidelity ratings. A is the best, E is the worst, and it shows you the median 5-year dividend per share growth. Again, this clearly showing you that those businesses with a better ESG rating have delivered better levels of income for clients. Again, early data, but one to keep an eye on over the coming months and years. Now, I'll finish with a very quick word on property. I think, I speak to a number of advisors during the year at roadshows and through webinars who say, James, the property debacle that we've seen in the last couple of years has been my biggest headache. Now, those reforms that we've seen have been even further delayed. So the FCA are now proposing something called a long-term asset vehicle to help manage redemptions in the space. And I think there will be a bit of short-term pain when we think about trying to work out the solution to not just liquidity, but also to redemptions from property funds. And what I would say, though, on the other side of things, I think there are still opportunities within the property sector. The reason I say this, if you think about kind of post-COVID, we've really seen a sea change and a real sort of pickup in the way that the property sector is put together. And one big winner post-COVID has been things like warehouses that distribute e-commerce goods to people's homes. And I know we've got Christmas coming up, and I don't know about any of you, but every single day I think I get a text message to say that an Amazon parcel has been delivered or is going to be delivered. I don't order any of them, but when you think about that kind of sea change, there will be opportunities in property, but I think we're going to have to be patient over the coming sort of months and years. So look, let me wrap up. I'm checking my time into the final couple of minutes. What I would say is, going back to the start, that income environment remains incredibly challenging. So those big structural factors, debt, demographics, when you think about interest rates, but also now with inflation and climate change, there's a lot to worry about for 2022. On the other side of things, though, we looked at the two different approaches. There are going to be opportunities for your portfolios within either picking your funds or with multi-asset funds over the coming year. And hopefully I've shown that actually it's not just about make everything ESG. That's not what I'm saying. What I'm saying is a focus towards sustainability can have an impact, or can help clients looking for an income, a tilt towards sustainability. So hopefully that covers off the learning objectives. And I'll finish with a minute on how we think we can support you at Fidelity. We've got 4 different ranges that are available for multi-asset. I'm going to focus on the Fidelity Sustainable Multi-Asset range. These are 3 funds that were launched this year. They've got a price point of just 0.5% OCF. Again, they're risk mapped to all the different tools, de facto to Dynamic Planner, Synaptic. And what I would say about these funds is the performance has been very good, but actually they're not necessarily ESG funds, but rather they are funds for retirement that are looking to do that accumulation journey with a tilt towards ESG. So again, early days, but they've been quite popular. And if you're looking for something in this space, please sort of have a look at those. And again, on the other side of things, if you're looking for a natural paying income fund, again, these are our 3 multi-asset income funds. The one I'd focus on is the multi-asset income fund in the middle. This pays a natural monthly income of between 4% and 6%. So again, we've seen many clients use it as an alternative to, say, the Pru fund. So that's a conclusion for the multi-asset funds. And I think that is bang on 30 minutes. So I will say it's been a real pleasure. Thank you for joining this morning. Thank you for all your kind of comments and questions. I hope everybody has a superb Christmas, and we really look forward to seeing you all and working with you all next year. Thank you very much.
Many thanks, James. Just a note again, if you've got any questions for James, then please feel free to send them through the chat function or note them in your feedback form, and we'll make sure that they're passed through to James for an answer. Next to your screens is one of our leading ladies, Rachel Vay. She's one of our senior technical consultants here at AJ Bell, and she's going to be covering off a technical roundup which should bring you up to speed with the latest legislative and regulatory changes for pensions and savings. And she's also going to round up what's happening and how this could affect your clients. So welcome, Rachel.
Thank you for joining this Christmas webinar for Connect. My name is Rachel Vay. I'm a Senior Technical Consultant here at AJ Bell. This morning, I want to cover a technical roundup. I want to cover 3 developments which have come out recently from government and regulators. There seems to be a lot going on at the moment for government and regulators, and the FCA, the TPR, the DWP, the Treasury and HMRC seem to be very busy. So I want to give you some details of some very important developments that are going to affect you and your clients over the next few months. There are 3 of them. I want to explain the draft rules for increasing the normal minimum pension age, and importantly, how somebody could protect an earlier pension age. I want to cover the new rules for statutory transfers and how people could lose their statutory right to a transfer. And then I want to finish by looking at a new requirement that's going to come in June 2022 to nudge clients towards guidance. So let's start with the normal minimum pension age. Now, this should have been a simple change to do, but unfortunately, it's got very, very complicated. So on paper, as I said, this should be fairly simple and easy to put in. The normal minimum pension age is the age from which your clients can access their pension benefits without any unauthorised payment charges. Now, they could take it from, at the moment it's 55, and they could take it from 53 or 52, they could access their pension benefits. But there would be severe penalties for both them and the scheme, with the risk that the scheme would be deregistered. So that's not going to happen. That's not the way that we work. The pension age is going up from 55 to 57 from the 6th of April 2028. Now, this is no surprise. The government signalled this way back about 7 years ago in 2014. So we knew that this was going to happen. And it's timed so that it follows the increase in the state pension age from age 66 to 67. We've got another increase to state pension age coming up a few years later. We're not entirely sure yet exactly what time, but that's going to take it up from 67 to 68. So the rules are, or the draft rules at the moment, because this is just in the finance bill at the moment, which is going through Parliament and should get royal assent in the summer. But the draft rules say that the normal minimum pension age is going up from 55 to 57 from 6th of April 2028. There are 3 exceptions. The first exception is anybody who is in a uniformed service pension scheme. For example, a firefighter or the police. They get to keep their current normal minimum pension age. The second exception is anybody who has already got an earlier normal minimum pension age through the A-Day changes. So at A-Day in 2006, before that, people used to get an earlier normal minimum pension ages through their occupation. So, for example, if they were a footballer or a ballet dancer, then they might have a normal minimum pension age of 35. And this was protected when we went through A-Day. The third exception is the one which is probably most interesting to you and your clients. This is anybody who has an unqualified right to an earlier normal minimum pension age, and that right is given them in their scheme rules, and that's the change that I want to just cover now. So anybody who has an unqualified right to take benefits from an earlier specific age under the scheme rules as at 11th of February 2021 can keep this protected age of, let's say, 55. So a few things to cover here. First of all, it could be an occupational scheme or a personal pension scheme that offers this right. It isn't just occupational schemes, and I think that's an important point to get across this today. The second thing is that this unqualified right has to be in the scheme rules as at 11th of February 2021. Now, this sounds like a random date, but this was the date of the first consultation on raising the normal minimum pension age, and that's what the Treasury set out at the time. So the scheme rules have to say you have this unqualified right. The person has to have been a member on or before the 3rd of November 2021. The finance bill was published on the 4th of November, so you can see where that date came from. So they had to be a member of the pension scheme on or before the 3rd of November 2021. Now, the Treasury was worried about some people who might be in transition to that pension scheme at that moment in time. So they covered that, and they gave some protection to anybody who had requested a transfer to that pension scheme. And if that request was started on or before the 3rd of November, then they also get the protection, even if they might not be a member at that point. So what's an unqualified right? Let's just unpick that a little bit. That just means that the member can take their benefits at an earlier age, and say age 55. So it will be an earlier age than the normal minimum pension age, and it will state 55 within the scheme rules. Now, there's not going to be that many people and many schemes out there that are going to offer this sort of protection. It's not going to apply to that many people, but it is going to apply to some. And the problem with it is trying to find out if it applies to your clients or not. Now, this is arbitrary. It isn't following a set rules. It just depends on how the scheme rules were drafted up. And that will depend on how the pension lawyers approached it, say 7 years ago or 8 years ago or whatever. And therefore, that's the bit that has to be covered. So, for example, AJ Bell, we offer a personal pension scheme, but we don't offer an unqualified right to take your benefits from age 55. We use normal minimum pension age, so it doesn't affect members of our pension scheme. So for you, it's probably worth trying to find out which of your clients have this earlier protection and are entitled to take their benefits from age 55. You will need to just get in touch with the pension schemes and ask them to let you know. The problem also at the moment is that occupational pension schemes aren't really looking at this at the moment. They haven't really considered it. So you might get an answer of, not very sure. So that's where the position is at the moment. Everyone's going up to age 57 from 2028, unless you fall into one of those 3 exceptions. You're a member of a uniform pension scheme, you already have previous A-Day protection, or you fall into this new category of having an unqualified right. Problem is that people don't stay put. They tend to move pension schemes and move from one pension scheme to another. So let's cover the situation if somebody transfers. I'm going to take somebody who has benefits within, and I'm going to call it an age 55 scheme. So they have an unqualified right to take their benefits from age 55. But they also have a 57 scheme as well. What happens if they transfer their benefits from the age 57 scheme to the age 55 scheme? In that situation, all benefits can be taken from age 55. They're all absorbed into the age 55 scheme. All new contributions will also get age 55 protection. So that's one way. Let's look at it for the other way. What happens if somebody transfers from an age 55 scheme to an age 57 scheme? Well, in that situation, the age 55 benefits will be ring-fenced. So the transferred in benefits will be ring-fenced, and those can still be taken from age 55. But the age 57 benefits, the other benefits which were in the scheme before, keep the age 57. That means that your client is going to have two different normal minimum pension ages within the same scheme. Now, that sounds very confusing. It has big knock-on effects for things like illustrations, statements, pensions dashboard, all of these sort of things. And it's just confusing and complicated for your client to understand. Furthermore, there might be some schemes that go, well, actually, do you know what, this is really complicated. I'm not sure we want to do this. So they might say, we just don't want to accept an age 55 scheme transferring in. And they say, we don't want that to happen. They could also just say, well, you can transfer in, but if you do transfer in, everything has to be taken from the normal minimum pension age. And they could write that into the rules as well. So it doesn't necessarily follow that your client can have this flexibility if they transfer from a 55 scheme to a 57 scheme. And again, you just need to have some conversations with the schemes. Now, this applies to any transfer on or after the 4th of November 2021. So as you can imagine, these are draft rules at the moment. They're not finalised. The chances are that they are going to go through to become enacted, and they probably won't change, but they're draft rules. But even now, any transfer that's coming from a 55 scheme to a 57 scheme could, in theory, get that protection. That means that people and schemes are going to need to know whether it is coming from a 55 scheme or not. So this sounds a bit complicated, lots of complexity to unravel. So I've covered the scenario where somebody transfers from a 55 scheme to a 57 scheme, and they just transfer on their own. There is another third scenario here, and that is somebody transferring from a 55 scheme to a 57 scheme, and they do it as part of a block transfer. Now, you will know what a block transfer is. It's if you transfer two or more people from the same scheme to the same scheme at the same time. If you transfer it as part of a block transfer, then all the benefits get age 55 protection, even the benefits which were in the 57 scheme to start off with. And that includes any new contributions going in. Now, these are block transfer rules, but a little bit of a word of warning, they're not exactly the same as the block transfer rules that we had under A-Day protection. Instead, they're slightly different. But the good news is that's to the benefit of your clients. Under these block transfers, you can partially crystallise if you want. You don't have to take all your benefits at the same time to get the protected earlier age. So that's three different scenarios of transfers, and for these rules coming in 2028. As I said, these are draft rules within the Finance Bill, but the Treasury has been through one big consultation and they've already changed the wording for the Finance Bill. So even though these rules are complicated, complex, add layers to our understanding and confusion for your clients, especially when they're trying to read statements or log onto the pensions dashboard or whatever it happens to be, I think these rules will probably stay in situ, but we will see what happens over the next few months. I'm not entirely sure that this protection really benefits anybody, apart from those it's going to give a job to, which is pension lawyers looking up the rules of all the pension schemes, and pension geeks like me who are going to be talking about it for the next few years. Let's go on to the second change. This is removing the right to statutory transfers. Now, As you will know, most people have a statutory right to transfer their pension scheme. And the reason they have this statutory right is just to make sure they're not held hostage within a pension scheme and the trustees say you can't transfer where you want to. So it's giving people that absolute right to transfer if they want to another pension scheme. Not everyone has a statutory right, but most people do. In addition to that, many of your clients will have a discretionary right to transfer, and that will be given under the pension scheme rules. So the trustees have can say that even if you don't have a statutory right, we have a discretionary right and we will let you transfer if you want to. So what's happening? What's the new intervention? Well, simple answer is to do with pension scams. Over the last few years, we've got progressively more and more pension scams, and the government is keen to take steps to close these down. Unfortunately, there are going to be criminals out there who are going to encourage people to transfer from one pension scheme to another. Maybe because it's suspect investments and they want them to transfer and invest in those particular things. Maybe it's to do with high charges. It could be to do with accessing funds early and taking them out before the normal minimum pension age, trust busting or pension liberation. It could be something to do with that. Now, before this intervention, ultimately, the scheme administrator couldn't stop that. So even if trustees had suspicions or scheme administrator had suspicions about the transfer destination, they were powerless to stop an insistent transfer. And this was underlined in a High Court case in 2016, which was Hughes versus Royal London. And they looked at this particular situation, but it said trustees cannot stop a transfer going through because a person has a statutory right to transfer. So what's happened is that the statutory right to transfer has been removed in certain situations, and that was put into the Pension Schemes Act of 2021 earlier this year. We now have regulations to back up that act and to say exactly how this will work in practice. And these regulations came into force at the end of November. So what I want to do now is to run through how these regulations work. Now, the reassuring note is that in the majority of cases, in most cases, your transfers and your client's transfers are going to go through no problem whatsoever. The regulations say that transfers can go through if they meet one of two conditions. The first condition is it goes to a particular type of pension scheme, and that is a public service pension scheme or an authorised master trust, or when we actually finally get them, an authorised collective money purchase scheme. So if the pension transfer goes to one of those three different types of scheme, it can go through absolutely no problem. The statutory right of transfer remains. In other situations, it's got to meet condition 2. And that is where the trustee or the scheme administrator says, I'm not worried about it. There is no concern. It can go through. Now, a lot of the transfers that we do out to different pension schemes go to roughly the same places, as you probably expect. So we have done our due diligence on those particular pension schemes. We know where they're going. We know how the scheme operates. We know that there is no concern. So we will draw up something called a clean list, and that will have the majority of pension scheme destinations on it. And those ones we've done our due diligence on, we know where they're going, we've got no worries, they will just go straight through. Then we have to take it down a step later. If there is an occupational scheme and it's a transfer to an occupational scheme or an overseas scheme, then we have to ask the member for more information. And we have to ask them for details about their employment link or their residency. We have to ask the member that information, and the member has to reply to us. No one else can reply on their behalf. So that's for occupational schemes and employment links. If you're looking at another pension scheme that we maybe don't know, or we've not really heard of them, or we have to do some investigation and to make sure that it passes our due diligence. And in that situation, we can ask for more information from the member, the advisor, we can go back to the pension scheme. We've just got to use our common sense to draw up some information. If in that due diligence a amber flag is raised, then what we have to do is to refer the member to Money Helper, which is part of Money and Pensions Service, and they will have to give the member scam guidance. So let's have a look at what these amber flags are. Amber flags are the member gave incomplete information when we asked them a question, or we don't think the evidence for the employment links or the residency is really robust enough and we think it's incomplete. We don't think the evidence given by the member is genuine, or we think that there's something wrong with the pension scheme. We think there's either high risk or unregulated investments, unclear or high fees, or something wrong with the structure of the investments. We're just not happy with it. We've asked some questions, but we're not particularly happy that should be the way it should be. So we're raising an amber flag. When we refer the client to Money Helper, they have to get a Money Helper scam guidance session. It'll take about 40 minutes to an hour. The Money Helper person will ask them lots of questions and ask them why they are transferring and just tease out exactly what's happening. Once they've been through that guidance session, then they have to give proof back to us that they have attended it. This is a unique reference number. Once we have got that as a scheme administrator, if there are no red flags, and I'll come on to red flags in a second, but if it's just an amber flag, they've got the guidance and the member still wants to transfer, then we just let the transfer go through. So red flags is when the statutory right to transfer gets removed. And these red flags are going to get raised if the trustee, that means that they just can ultimately stop the transfer going through. However, it doesn't mean that it's law that they have to stop it. It just means the statutory right to transfer has been lost. But remember, they could have a right to transfer under discretionary rules. So even if the trustees see a red flag, they could say, well, we'll let the transfer go through because we have a discretionary right to let transfers go through. I think it would be a bit peculiar if that happened. The red flags are the member has refused or failed to respond to any of the questions. They have not taken scam guidance, or they haven't given us the evidence that they've taken scams guidance. We believe that the financial advice is unregulated, or we believe that someone has been offered an incentive or been pressurised to transfer. So the question is that you're asking is, will this hold up transfers? And I don't think it should in the slightest. The vast majority of transfers should just go ahead. The pension regulator has put out guidance. Every pension scheme will be doing exactly the same as us and developing a clean list, and the majority of transfers will just go to destinations we know, and there shouldn't be any issue whatsoever. Now, there might be some situations where more information needs to be taken, and those will just, those transfers will have a little bit more scrutiny. Member will have to go and get guidance, and unless it's a red flag, and so yes, those might get held up. But this is partly how the industry approaches this, and the industry needs to take a proportionate approach. And if it does that, and it uses some common sense and a common sense approach, then most transfers should go through. So we've covered normal minimum pension age, the removal of the statutory right to transfer. I want to finish with an FCA set of regulations that have just come out for personal pension schemes, for non-workplace schemes, and this is for nudging clients to guidance. And I just want to cover what this means for your clients. So why the intervention? Well, the FCA is concerned that people aren't making the best decision when they're accessing their pensions, and they're not making a sensible decision about how they want to take their retirement options. They're concerned that only 14% of people use PensionWise, and PensionWise is there precisely to help people make better decisions. So a clause was put in the Financial Guidance and Claims Act. Now, this was put back in 2018, and it's one of these situations that a clause has been put in with particular wording, and the FCA has no choice but to follow through on this wording and to develop regulations that echo it. These regulations put in a stronger nudge to guidance at a particular point in the process. They're going to come into effect in June next year, so I want to run through what they mean in practice. So this affects the client at 2 points. When they access their benefits, so they say, I want to access my benefits. Now, the rules and the regulations are fairly prescriptive. They say exactly in the point of the process where somebody has to have this intervention and where we have to put in this nudge to guidance. So we can't do it in a particular part. We've got to do it when they request to take benefits. So it's not when we first realise that they are perusing the web pages on what their options are or anything like that. That's not the point. The point where we have to give the nudge is when the person says, I want to take my tax-free cash and I want to take it now. We take them through the normal process to get the tax-free cash, but at the point that we're ready to press the button, that is when we give them a nudge to pension guidance, and that's the way that the rules are going to work. But it's not only accessing benefits, it's when people transfer. And the regulations say that if they're over age 50, then we can assume that they're transferring to consolidate to access their pension benefits. So any transfer over the age of 50, we also have to give them a nudge at that point. So how does this work in practice? Well, first of all, we have to say that there is PensionWise is available and that somebody can access PensionWise guidance if they want. We explain how it works, what the nature of pension guidance is, and that they help people deciding on their final retirement options. We have to say that they can access it for free, and if they do that, they can choose, they get it from an independent pension specialist. Then we have to explain that they can take regulated advice, but this will be at their own cost. We have to offer to book them an appointment for them to receive pension guidance. So we have to offer that to everybody. Now, if they say, I don't want to, we struggle, we have to take reasonable steps to book this appointment for them. If they say, I don't want this appointment, I want to do it myself, I don't want you to book it, then we just give them information. Or if we're on how to do that, we'll give them a web link. Or if we're struggling to get the right dates and times, then we give them their information, the web link, and they do it themselves. Now, we cannot proceed with the benefits and paying out the benefits until we know that guidance has either been given or the person has opted out of taking guidance. So what does this mean for you and your clients? Well, there is a lot of talk about interventions from FCA and, for example, investment pathways and accumulation default funds. And you're probably thinking, this nudge to guidance, this doesn't affect my clients. Well, I hate to tell you, but it does. This affects all clients, including advised clients. It is at the exact point that they want their tax-free cash being paid out and they want to access their benefits or transfer. So it is a particular point in a process. We can't encourage opt-outs. So the client can come back to us and say, I want to opt out because I am taking regulated advice. So, but if they do that, they have to confirm that they are taking regulated advice and confirm that they want to opt out. So we need to get a confirmation back from them on that situation. And that hopefully will just be a tick box or something like that. but we need that confirmation back from the client. We cannot say to the client, oh, look, you're getting regulated advice. We know you're getting regulated advice. You can opt out if you want. We cannot say those words to them. We cannot encourage them in any way to opt out. It has to be the client who comes back to us and says, we want to opt out. We are taking regulated advice. The wording we use is very specific. We have to say it's from an independent specialist, pension specialist. We have to say it's free advice, but if they take free guidance, sorry. But if they take regulated advice, then they have to pay for it at their own cost. But it does throw, I think, a cloak over this and some clouds over this. And even the FCA, during the consultation, pondered whether clients would actually doubt the validity of the advice they're getting. If they've decided what they want to do with their advisor, they've made the choice, and then we say, shouldn't you be taking guidance? Do you want to take guidance? Then it confuses the message. I truly believe the timing is wrong on this. And for that reason, I don't think a lot of people will be nudged towards guidance. From our experience, when most people they don't wake up one morning and decide they want their pension benefits. They think about it for weeks or months. They investigate it. Non-advised clients investigate it. Advised clients will investigate it and will talk to you. They'll talk through their options. Non-advised clients will go onto web pages, they will read about it, they will look at articles in the newspaper, they will think it through. Then they will get in touch with us and say, we want our tax-free cash. They know what they want to spend the tax-free cash on, they know why they want it, and they just want it paid out in the next week or 2 weeks. So nudging them towards pension guidance at that point probably won't work. I don't think it's going to work, but we will see what happens. These are finalised rules and they're coming in from June 2022. And as I said, they affect all clients. So that's 3 areas we've been through. We've looked at the normal minimum pension age. We've looked at where the statutory right to transfer has been removed. And we also considered the nudge to guidance as well at the end. I hope that you found this session helpful and informative. And it only remains for me to say, I wish you a very Merry Christmas and all the very best for 2022. Thank you very much.
Thanks, Rachel. Now on to our final speaker of the day, Terry McGivern. Terry is our Senior Research Analyst, and today he's addressing the ever popular and increasingly in demand area of ESG and sustainable investing. He's going to take a look at some of the key details of various approaches fund managers, index providers and rating suppliers take before highlighting the potential pitfalls to look out for when navigating this complex sector. Our final speaker of the day, over to Terry.
Hi everyone, thanks for joining me today. My name's Terry McGivern and I'm a Senior Research Analyst on the AJ Investments team. Today I'm going to talk you through some things that investors need to be aware of when navigating responsible investing and building an ESG approach with which to achieve good investor outcomes. First place to start is probably with definitions. Now I imagine most people in the audience will be familiar with the all-encompassing label of ESG. But I think it's important that we define what ESG is, as getting the terminology straight will help us when it comes to the multitude of options that exist in the marketplace today. So ESG investing is a term that's often used synonymously with sustainable investing, socially responsible investing, which is also labeled SRI, or mission-related investing and things like impact investing. It can be defined as the consideration of ESG factors alongside performance factors in the investment decision-making process. Now that we know what ESG is in broad terms, what is it that it's targeting specifically? It's an investment approach that attempts to define factors that could impact not only investment outcomes and company performance, but also real-world externalities. And these factors are bucketed into 3 overarching labels, which give us the ESG label. This slide gives an example of some of the factors, but it isn't exhaustive. But if we just look at the 3 main areas, and we can see that they are environmental factors, or the E in ESG, and these are things like resource usage, efficiency, climate impact, fossil fuel usage, etc. Social factors, which is the S in ESG, and these are things such as employee rights, diversity of the workforce, equal pay. And then there are governance factors, which is the G in ESG, and these are things such as board diversity, board remuneration policies, and things of that nature. ESG investing has and is growing rapidly over the last couple of years as the level of research and media coverage and the awareness increases around things such as climate change and other big social themes. This is not only affecting current investors and their portfolios via changes in approach and products that are out there, but also regulations in terms of there being a strong regulatory tailwind behind ESG investing. But research has also shown that the beliefs and the values that are around ESG and ESG investing are quite firmly entrenched in the mind of millennials. Now, that may seem anecdotal, but it has been proven from research that millennials are more moved by some of these values and these themes. With them set to be the next investing generation, it's obviously a key area to be aware of and to be familiar with to future-proof your business and ensure that the services you can offer stay current for existing and also future clients. When we look at ESG investing, it is available in both active and passive formats. Obviously, I think traditionally it was seen as a more active pursuit. Fund managers were able to, take strong, meaningful deviations away from benchmarks and invest according to the conscience. And they've traditionally been able to take more forceful action on governance matters by divesting of companies that didn't fit the mold in their portfolios. So I think it was always traditionally seen as more active pursuit. Passive ESG investing is, though, a much more recent development, and the rise of smart beta and multi-factor indices has provided the framework for ESG factors to be targeted in passively. And the industry is growing at a dramatic pace over the last couple of years. I mean, if you look at most of the products that are coming out from providers these days, and the passive, fund providers will have some flavor of ESG attached to them, just because they recognise that is where the marketplace is. One thing to note is that on the passive ESG side, most of the products that come to market are now ETF based as opposed to index fund based. That is obviously because the ETF is the slightly more modern wrapper. There are efficiencies and benefits to releasing them in ETF form. So we are seeing a preponderance of ETF based ESG products coming out in the passive space. Obviously, whilst it's important for an investor to completely understand and be aligned with the investment philosophy and principles of any investment that they make in terms of into whether it be an active or a passive manager, I do think that the landscape for passive ESG investing is perhaps a little more nuanced due to the purely data-driven approach and the wide variety of rule sets which on the surface seem similar, but are actually when you dig below quite different, and we'll get to that. So this presentation, I am on the passive side of the AJ Bell investing team, so it is a little bit more focused on the passive ESG investing landscape, but that is because we do believe that is where more of the nuance is needed, without that very strong sort of active overlay. That being said, so as I mentioned, in the main, passive products that come to market are in ESG format, and Track Insight is a company that is a ETF specialist in terms of data providers. They produced this slide which shows that in 2021, ETF flows were ESG linked versus non-ESG ETF flows in Europe. We're seeing a 50-50 uptake in terms of net flows into these products. That is a huge swing from where we were a couple of years ago, where it might have been probably 90% were going into non-ESG ETFs. And if you look at some of the other regions like Asia Pacific region or the Americas, they're on a much lower rate in terms of net flows into ESG product. But it's certainly clear that Europe is far more developed on this path. Just historically, it's always been a little bit more tied to ethical investing, but certainly there's also strong regulatory tailwinds in Europe and the UK, for example, Paris alignment benchmarks, and also in the UK, you know, things like MiFID II, where there's a requirement to consider ESG as part of suitability. So them types of regulatory tailwinds are really, you know, pushing ESG product flows and really seeing big drivers into them in the European market. But with the previous slide just being the first 7 months in 2021, I mean, we look at this slide, there isn't a sort of one year or you know, even just a very short-term trend either. We can see in this graphic that from a very, very low base, total global AUM into ESG products has grown enormously, certainly over the last couple of years. And it doesn't show any sign of slowing down. I mean, this graphic runs from January 2014 and it runs up to July 2021. And from a negligible amount of AUM, you know, only 7 years ago, we're now looking at, you know, north of 300 billion into ESG ETFs. So, you know, there's a very, very, very strong trend in it going into these products, and it's certainly something to be aware of and cognizant of. And we don't really see any chance of it slowing down in the near term either. When we do look at, you know, the flows going into these products and you know, we look at the ESG ecosystem, the passive ESG ecosystem. I mean, if we just take a step back and think about, you know, standard asset classes and asset buckets that we know as investors for things like, you know, UK large cap FTSE 100, or, you know, a good representation of the US equity market, something like the S&P 500. You know, broad consensus has emerged over several decades to mark these indices as being, you know, the best representations. On the ESG side, given the rapid expansion of the theme and the number of product launches, the different indices that are available for the same asset class, etc., consensus hasn't yet really been found in terms of what is, you know, the definitive index provider, ratings provider that all of the product providers will coalesce around. And this, you know, and as an example, there's a list, and it's a non-exhaustive example because there's probably more than this now from even when I actually produced this slide. These are ESG products that track the US equity asset class. And I mean, if we look there, you know, there's a list of, I don't know how many's in there, probably around 20 different names, all with different slight variations of different indexes. MSCI is the dominant index provider in that list, but certainly there's indexes from S&P and also from Foxbury and also from FTSE. So, you know, there's a broad index spread, but at the same time, even when we look at, you know, the product names, you know, things like USA ESG leaders, S&P 500 ESG screened, USA SRI, you know, so many different variations on the same sort of nomenclature that it becomes very, very difficult to understand, you know, just on looking at the name itself, what is actually going on under the hood of them products. And not only do we have, you know, a number of ratings, products with all different indexes underpinning them and different names, we also have a number of different ratings providers. So one input that is present in all ESG products on the marketplace is the ESG ratings, and you know, just as this slide gives a small sample of, you know, there's over 600 ratings and rankings agents now. So, you know, the slide, there's some big names on there, there's some small names, some are independent, some are smaller parts of bigger businesses. It's an absolute spaghetti bowl of different providers and ratings, and it can make it very, very complicated to know which one is the best representation. But the ratings, the way to think about them is that they are computed by companies such as MSCI, Sustainalytics, ISS, and FTSE. And whilst you may think, you know, an ESG rating is pretty much black and white, a company is either good or a company is bad, ESG ratings should actually be thought of in a similar way to credit ratings, in that there is, or equity analyst ratings, in that there is some shared consensus, but different methodologies, different interpretations of the same data, different biases can creep in and lead to different agents and different rating agencies coming up with different conclusions about the same companies. A good example of this could be something like Tesla, which is deemed to be a good ESG company. The product it sells is electric cars, and it's a tech business. So on the other hand, it could be judged to be a bad company due to the perceived bad governance and reputation risk from, you know, some pretty cavalier CEO tweets, which, you know, I'm sure many in the audience are familiar with Elon Musk and some of his tweeting. So it depends what way that the companies, these rating companies, define certain businesses, but we can get some differences. The NMPAs, which is the Principles for Responsible Investing, for instance, they calculated the average correlation across 6 ESG rating providers was only 0.46, which I imagine is lower than many in the audience would have expected. And just looking at that slide, you know, which is a snapshot of the sort of correlations between. I mean, you look at, you know, a business such as Asset4, which is owned by Thomson Reuters, and Sustainalytics and Bloomberg, they've got quite high correlations. But then you compare, you know, something like InRate to Bloomberg, and it's got, you know, a correlation of 0.12. So, you know, there are very big differences in terms of how these different ratings providers do judge, you know, different businesses, and it's something really that we need to be aware of when we're deciding on which rating system we're going to use as part of our investment process. All of them differences in terms of indexes and in terms of rating providers feed into the underlying product. You know, and just on this slide, you know, it gives an example of 3 US equity ESG products. So we've got the SPDR product, a UBS product, and a HSBC product. And when we basically look at what are the overlaps in holdings, we can see that, you know, that it probably isn't as high as we maybe would have expected. It's likely to come as a bit of a surprise that across all 3 indices, there's less than 20% overlap. There is decent crossover between something like the UBS and the HSBC product, which totals around 60%, but there's still 40% in terms of differences in weights. And then the SPDR product is even less, sharing, you know, only around 25% with the UBS product and around 32% with the HSBC product. So, you know, so these 3 products that on the surface you may think target the same asset classes and should give similar performance, they can actually be doing very, very different things under the hood. And it's another thing to be aware of and ensure that we know what's going on with the individual products, how they're constructed, what ratings methods are they using to build the indices, so that we understand when we blend them together what effect we're going to get in our portfolios. And that's just sort of compounded, and this slide just sort of gives a little bit of colour to, you know, the index issue. So MSCI's lineup, for instance. So even if we decide we're going to use MSCI's rating, we're going to use products that track MSCI benchmarks. MSCI itself have a range of ESG benchmarks, you know, that they will make available to product providers, and this slide sort of highlights them. So we start on the left-hand side with, you know, very focused climate, particular climate ESG products. Then we start to move through the level of integration from very light touch into a lot more, you know, sort of more heavily integrated ESG products. And then on the far right hand side, we've got, you know, what I would describe as almost focused thematics, which looks at things like impact investing, or, you know, very focused ESG factor exposures like women's leadership or things of that nature. So not only do you have to get your ratings provider right, not only do you have to get your index exposure right, you then have to make sure that you choose a product, you know, that sort of fits. So it is a very, very multifaceted and complicated investment analysis at the moment, because there isn't any single standard that's being coalesced around in terms of the ESG rating, or who is, you know, the sort of gold standard in index provision in this space. MSCI do try to help investors find the correct index. They recommend the use of things like decision trees, and this is something that we'd recommend, you know, when you're building your own approach to ESG or helping your investors navigate the, you know, the abundance of indexes out there. Things like decision trees based on values and beliefs can be very helpful to allow you to dial into which is an appropriate index to use as a benchmark. So MSCI do try to help investors on this path, and it's something certainly to bear in mind when it comes to building your own ESG approach. And then when we look at, you know, the level of inclusion in terms of not only which ratings provider, index provider we'll use, but also how heavily do we want to expose ourselves to ESG factors. I think historically the most popular responsible investment style has been ethical investing, which is probably similar to faith-based investing. You know, there's excluding companies that don't necessarily fit with your morals or values, and you know, there's evidence of this going back a long time. But you know, even most recently, sort of around the 18th century, when the Quakers prohibited members from being involved in companies that were linked to slavery. You know, there's a long history of investors who have strong values and beliefs, eliminating companies based on them. Many of the common areas that we see avoided today include things like tobacco, alcohol, gambling. However, there are some issues with an exclusionary only or ethical style of investment, and the three main problems would be, you know, defining a standard moral code that applies across all of your investor base is very difficult. You know, what one person may see as a sin stock, another person might see as not being a problem to have in their portfolio. So this sort of one size fits all exclusion is quite broad brush and can be problematic when we're trying to deal with individual investor outcomes. The definition of whether a company is actually involved in certain activities is open to some nuance as well. Something like a tobacco producer, you know, it's clear as day that they make a living and revenues from production and sale of tobacco. So if that was one of the things that you wanted to exclude on it, it's simple enough to do. Well, there again, you may have a paper manufacturer who produces the paper that the cigarette manufacturer uses, and that might only be a small part of the paper manufacturer's revenues, but do you exclude them completely? You know, it starts to get quite difficult when you look at, you know, supply chain and revenue generation right the way through, you know, what are in some instances really broad businesses with many different business lines. How sort of heavy-handed you get at excluding companies can be difficult. And then lastly, you know, there are some unethical companies that actually produce very high investment returns. So I'll keep picking on tobacco, but they've done really well. You know, it's a very stable cash generative business, which isn't subject to the same cyclical whims that some businesses are. You know, people who smoke are likely to continue smoking, whether they're in good times or bad times. And they may even smoke more in bad times if you know, if they see it as a stress reliever. So, you know, them types of businesses sometimes can act as a bit of a catch, a safety net, you know, in terms of when markets take a dip, they continue to generate cash and they continue to throw off yield, and excluding them completely can mean that you do, you know, there are some sacrifices to be made in terms of investment returns. So if an exclusionary only approach lives, like on this slide, which shows, you know, the various levels of integration, lives where the red box is. You know, some of the other ones that you can start to see is one that's more includes not only a negative screen, but also some ESG integration. So we take out the worst of the worst and then try to just sort of, you know, arrive at some that have got slightly better ESG credentials, and that would be the sort of middle box. Then there are others that actually move to a positive screening. And what that means is it takes out the negative stocks at the start. It then basically tilts the portfolios to stocks that have positive ESG factors and takes only the best of them. And that's the sort of area that AJ Bell has decided that we would try to inhabit with our responsible products. We combine both a negative screen and a positive screening process to try and basically weed out the things that could harm the portfolios, but then also tilt the responsible portfolios to things that have much stronger ESG factors and ESG scores. So we would live on that slide in that where that green box sort of lands. And as this slide sort of goes into, you know, AJ Bell, we wanted to exclude companies that operate in certain business areas that are deemed to have not met minimum standards, whether that be on things like human rights, anti-corruption, employment rights, environment, or anything that's been involved in serious controversies. And then we want to specifically reward companies that take positive steps to integrate environmental, social, and governance factors into their business strategy. And we believe that helps us sort of mitigate risks, but also take advantage of opportunities within these areas. And to that end, you know, when we've looked at what ratings provider we're going to use and what index provider we're going to use so that we get this real consistency of outcome, we have decided to use the MSCI SRI indices. Now, the SRI indices from MSCI is, as I mentioned on the previous slide, they sit very much in that green box, so that there is an exclusionary screen on one side at the start. and then there's a basically scoring system, and then the SRI index only takes a subset of the top scoring companies, which I can explain on the next slide. One problem that we do have is that there's not necessarily an SRI index for every asset class or asset bucket that we may include in our asset allocation or portfolios. And what we generally do then is we still use MSCI indexes, so that we still get the same consistency of rating and the same, ideas that are going into the index formation, but we may dial back, and maybe choose a product that tracks an MSCI leaders index as opposed to the SRI index, which uses the exact same methodology, but it just has a slightly looser inclusion. So the SRI indexes use the top 25% of ESG scoring stocks when they build their final index, and the leaders version uses the top 50%. So it's just slightly looser rules, but we have had to make use of these types of indexes where there isn't a sufficient SRI product out there in the marketplace yet. But certainly the SRI indexes and the products that track the SRI indexes form, the bulk. I think there's only possibly two lines in the responsible fund that doesn't track an SRI index, and it generally is one of the better served index areas, ESG index areas in the marketplace, with a lot of providers bringing products out in line with that SRI methodology. And this slide just sort of, illuminates that a little bit. It shows some of the business lines that we exclude, or that MSCI exclude as part of the SRI indices. Things such as controversial weapons, nuclear weapons, tobacco, adult entertainment, thermal coal. It's quite a broad consensus, I think, in this sort of area around, business lines that I think the industry has sort of coalesced around, that they believe, represent a good first step of removing from the full fat index. So we, MSCI, when they're building these indexes, they remove these types of businesses. Some of them have zero tolerance. Some of them are able to make a very small amount of revenue from the industry before they will be removed. And it's slightly different depending on whether they're pure producers or whether they're distributors, as I mentioned before, in terms of, a tobacco producer versus a paper manufacturer that, does sell some cigarette papers. So, MSCI are trying to ensure that they're not too heavy-handed with the exclusions, but also, that they are removing the things that most people would agree would be classified as, slightly controversial sort of industries. What they also do is tack on almost a current list of companies that may be in controversy at the moment. So companies maybe such as, let's say for argument's sake, VW, who maybe otherwise have been included in the index and got past the first exclusionary screen. When they're involved in the emission scandal that we've seen, there's been a lot of media attention and news generated as a result of that. That is deemed a controversy, and that would see them removed from the index. They wouldn't be able to progress beyond the exclusionary screen, just because a business that is subject to current controversies can be harmful to a portfolio. There could be further bad news to be uncovered. There could be fines and things of that nature. So businesses that are not necessarily involved in sin stocks, but are involved at the moment in controversies that are affecting their businesses, they will be removed from the first cut of the index. What MSCI then do is, after giving a score, which is similar to a bond rating, you can see it there on number 2, where it runs from CCC up to AAA, with C being the lowest quality and AAA being the best quality in terms of ESG factors. Each company is given a score. The next stage that MSCI do then is basically say we will remove any company that has a score that's below A. So BBB and below are taken out of the universe, which leaves a rump of businesses that have gone through the exclusionary screen. They've got very, very strong ESG factor scores, and they've taken the strongest of them ESG factor scores. And then the final step that they do is they take the top 25% of scores for each sector and build the index from that. And the reason they do this is to try and maintain sector neutrality, and allows them to sort of approximate the same sort of characteristics that you'd expect from the full fat index, but in ESG form. Otherwise, what you could find could happen, like things like tech companies that have pretty strong ESG credentials. They don't have a lot of staff. A lot of it is, automated and digitized and on computers. So they have less issues with labour and unions and workforces. They're, some of the most highly valued and wealthy businesses in the marketplace today, so that their employees are pretty well compensated. They don't use any natural resources or things of that nature, or have any sort of mining or controversies. So a lot of tech companies score really, really well on the ESG credentials. If we didn't have this step that basically took the top 25% of scorers for each sector, and we just took the top 25% of scorers, for instance, or the top scorers, we could end up building inadvertently a portfolio or an index that is biased towards a particular sector, which can cause problems elsewhere in the portfolio. So it's a really robust, repeatable index construction methodology that MSCI have got on these SRI indices, and that's why at AJ Bell we decided that we would make use of them when we were designing our own products. That allows us to be consistent in terms of the ratings provider being MSCI, the scoring system that they use being MSCI, and the index methodology and construction also being led by MSCI. And that means that we do get consistency of outcome when we're blending these sort of products, different regional and asset class products together. And this slide just sort of brings a little bit of colour really in terms of what could potentially happen in terms of performance, risk-adjusted performance, by following this type of approach. So obviously we know history is no indication of future performance, and this graphic just shows a period from June 2013 through to May 2018. It's provided from a slide deck that MSCI produced in 2019, so it's slightly dated, but I think it still brings colour to the story really in terms of the SRI indexes. So if we start at the black dot in the middle, which is the MSCI ACWI index, it's delivering roughly around an annualized total return of around 6.5%, with a max drawdown of around 19%. The first screen that MSCI would overlay would be an exclusionary screen, as I've mentioned, and this illuminates some of the issues you've got if you only use exclusionary screens. Once you remove some of them companies that the likes of tobacco stocks and things which can do well in some investment environments, you may get a small, or you may not, but in this case there is a small improvement in return, up to around 0.2% or something, so nothing dramatic. But there is a bigger increase in terms of the max drawdown, so the risk-adjusted return is hampered in terms of it being nearly a 1% increase. 1% increase in the max drawdown in return for a 0.2 increase in an annualized total return. So this just sort of highlights some of the issues that you have when there's only an exclusionary screen applied to the full fat index. As I mentioned, what the SRI indexes then do is try to tilt the portfolios, the people who have got the companies that have got through the exclusionary screen, tilt them towards the highest scoring ESG factors, so that the portfolio is the best of breed really, and we call this positive screening. And when MSCI do this on the ACWI, after they've run the exclusionary screen and then obviously moved to build the index on the back of the rating system and the top 25% in each sector, what we actually see then is a smaller max drawdown from the starting point of the full fat index of around 1% to 2% better than just the exclusions. And we also see a higher total annualized return of around 7%. So we've seen like a 0.5% improvement in annualized total return. So this just sort of shows, in a real world example, what happened to the MSCI ACWI by going through the various stages that MSCI have taken to build the SRI indices. And I think it's a really nice example to show what can happen. Obviously, we know history is no guarantee of future performance, but it just sort of brings to light, some of the things that I was saying in terms of what happens if you run a purely exclusionary screen, what happens when you then run a positive screen afterwards. I think we can see that it does improve risk-adjusted performance, particularly in this example. And that sort of leads me, to how AJ Bell can help. As I've shown, there's a multitude of things that you need to be aware of in the ESG space, whether it be the ratings provider that you choose to use. It's difficult to choose which one. Different companies, will be scored differently by different rating providers. The index provider that you choose to use in terms of will dictate which the availability of products that is available to you, and which ETF or fund you're able to use, and all of these different layers and different steps. It is a very fast-moving feast at the moment, the ESG space, and it does make building an investment strategy and an investment approach that is tilted towards ESG or satisfies ESG needs quite a complicated and quite involved process. To that end, AJ Bell, have tried to bring to market some products that we believe can help advisors and can help individual investors. We started out with the AJ Bell Responsible Growth Fund, and this was launched to give almost a one-stop growth outlet for responsible investors. It carries a similar sort of risk rating to our AJ Bell Adventurous Fund. And the idea behind the Responsible Growth Fund is that it was a passive implementation, which allows us to control costs from third-party products that we include in the portfolios. It's built using the MSCI SRI indices, which gives us a very consistent approach, a very consistent idea of how the portfolio will hang together, and how areas will blend. We're not suffering from that same issue that I highlighted before, with different funds having different overlaps of companies. And it also allows a strong reduction in carbon intensity and a big uplift in the ESG rating versus a standard AJ Bell comparator product from our standard growth range, such as like the Adventurous Fund. So we brought the Responsible Growth Fund to market first. It did have a capped fee of around 1%, and that was to allow for the higher cost of the products that we're using underneath the hood. But as that product has scaled and taken in some great, very strong AUM, similar to our other ranges, we passed on the benefits of that scale to our investors, and the OCF is now below 50 bips on that product. So as that product gets bigger and bigger, the cost of accessing it becomes smaller and smaller, which we think is a great outcome for investors. Been really pleased with the performance so far of the Responsible Growth Fund, and it's done really well in the marketplace. So that's one option in terms of an option that sort of catch-all. More recently, this year we brought out the Responsible NPS range. Now, advisors who use our service know that we have a full range of NPS products in standard growth guise, and we also have income products out there. With the responsible range, slightly different than our other products, we offer them in just passive form. It's an indexed implementation, the same as on the Responsible Growth Fund. We just think that this allows us to control costs a lot better and allows us to be very consistent in terms of the index that is being tracked and the methodology that's being used. And what the responsible NPS is, there's 6 different NPS risk ratings, which run from the cautious up to equivalent of global growth. And what the NPS models do is they hold 25% of the Responsible Growth Fund in each model, which allows us to be a lot more hands-on and reactive, if needs be, without necessarily causing undue turnover in the model portfolios. We can make changes to the Responsible Growth Fund, which can dial up or down the sort of the risk or the exposures in the underlying NPS portfolios. So we think it gives a very good broad range for advisors to access in one convenient package, whether it be the fund or whether it be one of the the NPS models, a well-researched, well-constructed and consistent responsible investment product for your investors at a very, very competitive cost. I do believe that we're one of the lowest fee responsible products out there in the marketplace. We only take 15 bips annual management charge, and that's fixed on all of our investment products. And as I mentioned, the fund itself is below 50 bips. I think the third party cost in some of the NPS products runs from around 27 bips up to around 35 bips. So we should be coming in under 50 bips in every one of these models, and certainly within the fund. And as I say, in all of them, we see an improvement in terms of carbon intensity and an uplift in the ESG rating versus a standard AJ Bell comparative product. So if there are any areas that you believe AJ Bell could help, or you're looking for a solution for some of your clients in a responsible investing capacity, our product range is designed to take away that complexity, some of the issues that I've just talked about today, and allow you to access a way to access it in a very cost efficient way, and a very thought out and consistent approach to building a responsible investment strategy. So hopefully that's been useful, and has highlighted some of the areas that you need to grapple with if you are going to take on the responsibility of running a responsible investment approach. It is a complicated area. It's a fast growing and very fast moving area, and we're seeing a lot of developments, whether it be on the regulatory front, but also within the product front. And obviously it's a tough one to keep abreast of. But if there is any questions on any of the material, if there's any questions around the AJ Bell responsible products, or around the wider AJ Bell investments product set, do get in touch with your usual contact, and they can bring the question to us. If we can come back over email or wherever, if they can answer it, they will do a first port of call. If not, it will get kicked up into the investment team, and we're happy to answer questions should you have any on any of the products or anything that we offer across our range. So thanks for listening today. Hopefully that was useful, and Merry Christmas.
Thanks, Terry. That brings our session to a close today. Please don't rush off, so make sure you complete the questionnaire. It's a 2-minute job, and it makes sure that you get your CPD and a copy of the slides that will be through tomorrow. Final, if you want to submit any more pictures to our Twitter and LinkedIn poll, make sure you put them on either Twitter or LinkedIn today, and hashtag us in with AJ Bell Connect, and make sure that you copy in AJ Bell copy in Invest Centre. We're going to pick the best 3 pictures, and they'll all get a bottle of fizz through to them very shortly. Full T's and C's on our event website as well, so if you just want to have a read through those, they're on the AJ Bell Connect website. Until we see you again, hopefully in the new year, stay safe and have a very Merry Christmas. Thank you.